Welcome to Market Insights. I'm Jenaia Clarke, Financial Wellbeing Champion for Cambridge Partners. In this issue, we're talking all about tax. Today, I'm joined by our financial advisor, Ashley Salt, who spent many years as a tax accountant and is our Cambridge Partners tax specialist. It's that time of year when providers release their annual tax reports, so we thought we'd give you a few helpful hints on tax. We'll be breaking down the different types of tax rates, and why investors may need to submit a tax return. This information is general in nature and relates to individuals and partnerships. It should not be regarded as specific tax advice, as it does not consider your personal situation. We encourage you to seek professional advice from a tax accountant where you require tax advice that relates to your situation. Ashley, there's a few types of tax rates when it comes to investing, particularly resident withholding tax or RWT and prescribed investor rates or PIR. Firstly, can you tell us a little bit about RWT?
So, resident withholding tax, or RWT, is tax deducted on investment income, such as interest on term deposits or directly held bonds, and dividends from directly held shares paid to New Zealand tax residents. Paying RWT means that you have paid tax as you receive the income, so you should have less tax to pay when you file your tax return at the end of the year. If you didn't pay RWT, you would likely have a larger tax bill at the end of the tax year. RWT is calculated using your RWT rate, and this rate is determined by your annual income. RWT is deducted from the interest payments at source, so by the bank or the company paying the dividend or interest at the time of any payment.
Okay, so RWT is the tax deducted from certain income paid to New Zealand tax residents, and the rate is based on your annual income?
Yes, that's right. So investment income from portfolio investment entities, or PIs, doesn't have RWT deducted though, and the income from some PIs is taxed based on your prescribed investor rate or your PIR.
Okay, so can you tell us a little bit more now about PIR?
Yeah, sure. So a PIR is the rate at which tax is deducted from investment income earned in PIs. And PIs are a certain type of investment entity, including like managed funds and most of the KiwiSaver schemes. So each individual investor has a PIR, and PIRs will differ between investors, and they may even change for investors over time. So each individual investor within a certain type of PI has taxable income attributed to their unit holding, and tax is deducted for each investor using the individual's PIR rate. So your PIR rate is determined by your annual income or your income in either of the last 2 tax years. There are currently 4 PIR rates: 0%, 10.5%, 17.5%, and 28%. And these rates may differ from your RWT rate or your marginal tax rate.
Okay, so you mentioned before that PI investors have taxable investment income attributed to their unit holdings. Can you just give us a brief explanation of what that means?
Sure. So when you invest in a PI, you essentially hold a unit in a PI, and some types of PI funds do not pay tax themselves on the income, but they attribute the income to the unit holders. And so this income is taxable, but the PI will pay the tax on your behalf where you've given them your PIR rate.
So RWT and PIR are very similar in that you're paying some of your tax upfront. So there is less additional tax to pay when you file your tax return. And the rates are based on your annual income, but your PIR is only used when you're invested in a PI fund. Is that right?
Yeah, that's right. Yeah.
Many investors will be receiving their tax reports through their investor portals or dropping in their inboxes right now. What can investors expect to see in a tax report?
So your tax report collates all the information on your dividends and interest and distributions received and processed during the year.
Does it tell you how much tax you need to pay?
Unfortunately, it doesn't give you one figure that you have to pay tax on, but it does make filing your tax return much simpler. For our Cambridge Partners FNZ clients, we recommend that you provide your tax report as well as the FNZ user guide to your tax advisor.
So who would need to file a tax return?
So whether you need to file a tax return will depend on what sources or types of income you receive. So you may not need to file a tax return if, say, you only invested in PI funds and had no other untaxed income for the year, as Inland Revenue would automatically assess your income. But our portfolios have PI income as well as foreign investments. And investors that have foreign investment fund income, which you may hear being referred to as FIF income, or income derived overseas, these people generally need to file a tax return. And this is because the foreign investments are generally not taxed at source. So you need to ensure that the income from these investments are reported to Inland Revenue and taxed at the correct rates, which you can do when you file your tax return. But if you are unsure on whether you need to file a tax return or not, we would recommend that you speak to a tax advisor or accountant.
So what do you need to do to ensure you're paying the right amount of tax on your foreign investments?
This can be quite a complex area. And again, if you are unsure, speak to a tax specialist. But as way of an example, so for individuals and trusts, there are a couple of different methods that can be used to calculate your foreign investment fund income. The tax reports show you the calculations under both of the methods, and you'd have to return the income under one of these methods by including that amount in your tax return. But it's also worth noting there are some consistency requirements for FIF income, and you have to use the same method across all of your foreign investments. So say you did have foreign investments outside of your Cambridge Partners portfolio, you would need to use the same method over these investments as well.
Gotcha. And look, it's been a really volatile year for investments. For clients that may have had negative returns for the year, can they still expect to have tax to pay?
Yeah, because although you may not have any tax to pay on your fifth portion of your portfolio, you may have had income from other sources, such as interest and dividends, that will be taxed. However, when markets do go down, there may be a loss from some of your investments that you might be able to claim in your tax return as well.
Can I claim expenses on my tax return?
Yep, you might be able to claim some expenses in your tax return, such as portfolio fees, and any claimable expenses will offset your taxable income. But talk to your tax advisor if you're unsure about what expenses to put in your tax return.
Thanks, Ashley. For our clients and anyone else who's interested, tax returns are due by 7th of July. Don't leave it till the last minute to complete yours, but also if it feels a bit overwhelming, that's okay too. Give us a call or talk to your financial advisor who can recommend a tax specialist that would suit your needs. We hope you found this video informative. Ka kite anō.